This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter. Joining me for this update is portfolio manager Josh Wein. Josh manages the Hennessy Cornerstone Growth Fund, which was recently named in the Wall Street Journal's Winner's Circle. Let's jump right in. Josh, what is the overall investment strategy for the Hennessy Cornerstone Growth Fund?
Well, Jay, the Hennessy Cornerstone Growth Fund is an all-cap portfolio of 50 stocks that marries growth, earnings growth, price momentum, and valuation. So there's a strict valuation framework that we can talk about. But yeah, the market cap threshold is anything from $175 million in market cap and higher.
Excellent. What is the investment process for the fund?
Sure. The growth fund, we look for stocks with 175 million in market cap and up, and then the three rules that we use. It's a rules-based fund. We look at year-over-year earnings growth. We look at a price-to-sales ratio of less than 1.5, and then we look at 3 and 6 month price momentum. And so we are very disciplined in that we don't deviate from it, and we leave it be. It's a framework that has served us well for many years.
So what is the sell discipline for the fund?
Yeah, that's the best question that can be asked of the fund. And there is no sell discipline. If a stock goes up 100% or down 50%, there's no second guessing. And we don't truncate returns by selling at a predetermined level or a predetermined valuation level. I think that makes the fund, fairly unique. I think everyone would give you a very thoughtful answer as to what the sell discipline is. And our thoughtful answer is that there is not one.
So Josh, as you look at the fund today, what is the composition?
Yeah, so the composition of the fund, it's 50 stocks, as we mentioned. The top three sectors that the fund is exposed to comprise about 65% of the fund. So it's industrials, energy, and IT. And the market cap range, as we mentioned, we have a low threshold for inclusion in the fund. Right now, it's about 350 million in market cap, all the way to about 90 billion in market cap. So, all cap portfolio and relatively concentrated in its sector exposures.
This fund has delivered great performance over multiple time periods. What do you attribute those results to?
Well, beyond discipline, because I do think, as trite as it sounds, I think it is all about discipline. I always say that when we put the portfolios together, I always think to myself, if we were doing this in a fundamental way, bottoms up, top down, whatever it might be, we probably wouldn't concentrate investments as much as sometimes we do in certain sectors. But I think more practically, I think the valuation framework is relatively restrictive. And so I think we avoid some of these exciting high-flying names that, double in the span of a week on a great report or a great announcement or a great rumor. So, as much as we avoid those, which sometimes is unfortunate, we also avoid when they come back in about 50% in the span of a week, or the names that are trendy that have nothing behind them. So I think, I think our valuation framework makes it less exciting day to day, but I think that, again, has served us quite well.
So Josh, why is the price to sales ratio so important for this strategy?
Yeah, I think building on the prior question, I think it's important because it does keep us away from, concept names, ideas, big ideas that, don't have anything behind them. The 1.5 price to sales is unusual for a valuation framework, and it does steer us toward, industries like industrials that are more established, tend to have lower margins, tend to not invite competition. They're not exciting, scalable industries like software might be, things like that. And then I think also, a lot of people ask, do we use price to earnings? And we don't. Price to earnings makes sense on the surface, and it's used quite well by many, but I think what you don't get are turnaround stories. So when a company goes from losing money for a year or two to turning the corner and making a penny or two a share, those PEs can be infinite. If you're earning a penny a share, you could have a PE of a few thousand, and then the next year you make $1, and all of a sudden the PE is 12. So, I think that we are catching some interesting turnaround stories from companies that, have gone through a dry spell and are, coming back.
Where does this fund fit in a diversified portfolio?
Well, I think, in a world where understandably many people use index funds and ETFs, I think that it's idiosyncratic. It's kind of a deep value type fund that, over its long history, nearly 30 years, has done quite well.
All right, Josh, let's discuss a couple of the holdings in the fund.
Sure.
Tell us about MCOR.
Yeah, so MCOR, is an industrial name. They're engaged in, building services and construction, HVAC and lighting and overall, construction services. And it's an interesting name. It's very emblematic of a lot of the exposures in the fund. And, while it's not a thematic fund, there are names like MCOR that are very much participating in the build out of infrastructure, which we hear a lot about, and also onshoring. So data centers, semiconductor manufacturing, these are big projects, require a lot of subcontractors and managers of these projects, and MCOR has been able to capitalize on that and has done quite well.
Could you tell us about Urban Outfitters?
Well, yeah. So, we mentioned turnaround stories earlier, and I can't say that Urban Outfitters is a turnaround story, but it is a name that has been around a while, got a lot of attention in the early 2000s for their core Urban Outfitters brand. But they're also owners of Anthropologie and Free People. So Free People is one of their newer brands in the sense of it really starting to grow and become more of a driver for that company. So I think it's a great story to talk about from the viewpoint of, these names that are forgotten, that people kind of used to hear a lot about on, the popular news channels, and they kind of fade as new things come about. But, it's still around, still doing well, and, is a holding in the portfolio.
Josh, last question. How is this fund different from the Hennessy Cornerstone Mid Cap 30 fund?
Yeah, the only difference is the market cap. So the growth fund is, greater than 175 million in market cap, and for the mid cap 30 fund, that criteria is between 1 and 10 billion in market cap, and that is the only difference.
Josh, really appreciate your time. Viewers, to learn more about Hennessy Funds, please visit hennessyfunds.com.
Thanks, Jay.